Since 1944, every barrel of oil, every ton of copper, and nearly every major international loan has been priced in one currency, the US dollar. This isn't just tradition. It's America's most powerful geopolitical weapon. But now, for the first time in 80 years, a coordinated coalition of nations controlling over 40% of the world's population and a quarter of its GDP is building a financial system designed to operate without it. This is the story of de-dollarization, and it represents the greatest threat to American financial supremacy since World War II. The dollar's reign gives America what former French finance minister Valéry Giscard d'Estaing called the exorbitant privilege. Because the world needs dollars for trade, the U.S. can print money to pay its debts with less fear of inflation. It allows American companies to do business globally without currency risk. It gives Washington the power to sanction any entity by cutting it off from the dollar-based banking system, SWIFT. This privilege translates to cheaper imports, lower interest rates on government debt, and immense global leverage. Losing it would fundamentally alter American prosperity and power. The challenger is BRICS, originally Brazil, Russia, India, China, and South Africa. But in 2023 and 2024, the bloc expanded dramatically, adding economic heavyweights like Saudi Arabia, the UAE, Iran, and Egypt. This is no longer just an emerging market club. It's a geopolitical counterweight. These nations share a common frustration, a global financial system dominated by the U.S. and its allies through the IMF and World Bank. Their collective goal is to reduce dependency on Western institutions and the dollar that underpins them. So, what would a BRICS currency look like? Proposals range from a digital currency backed by a basket of member currencies to a more radical idea, a commodity-backed unit, potentially tied to gold and the group's vast natural resources. Imagine a currency backed by Russian gas, Saudi oil, Chinese manufacturing, and South African minerals. The theory is that such a currency would have intrinsic value, unlike fiat dollars, and appeal to commodity exporting nations globally. However, the details are murky, and getting rival economies like India and China to agree on monetary policy is a monumental challenge. The single biggest accelerant for this movement has been the weaponization of dollar-based sanctions. When the U.S. and Europe froze roughly $300 billion of Russian central bank assets in 2022, it sent a shockwave through every nation that might one day cross Washington. Overnight, holding dollars in Western banks went from being safe to being a potential liability. This existential fear has driven countries from China to Brazil to actively seek alternatives, not because they love each other's economies, but because they fear having their own financial reserves held hostage. The shift is already happening in the trenches of global trade. India now pays for Russian oil in UAE dirhams and Indian rupees. China and Brazil have agreed to settle trade in their own currencies, bypassing the dollar entirely. Saudi Arabia is openly considering pricing some oil sales to China in yuan. These bilateral deals are like small cracks in a dam. Individually, they're minor. Collectively, they erode the dollar's role as the universal medium of exchange. The share of global trade conducted in dollars has fallen from nearly 90% in the early 2000s to just under 75% today, a significant decline. Creating a true rival to the dollar, however, is astronomically difficult. A reserve currency needs three things: deep, liquid financial markets that are open to all, a trustworthy, independent central bank, a legal system that protects property rights. The BRICS bloc currently lacks all three. China's capital controls and opaque financial system are major barriers. Who would trust a central bank run by a committee of geopolitical rivals? And would investors feel secure holding assets under Russian or Chinese legal jurisdiction? These are not minor technicalities. They're the bedrock of global trust. History offers a crucial lesson. The British pound sterling was the world's dominant reserve currency for a century. Its decline was not a sudden collapse, but a gradual, decades-long process tied to Britain's diminishing economic power and the colossal rise of the United States after two world wars. The shift was cemented by the Bretton Woods Agreement in 1944. This historical precedent suggests dollar dominance won't end with a bang, but with a long, slow whimper as economic gravity pulls power toward new centers. For the average American, the end of dollar supremacy would be profoundly felt. If the world no longer voraciously demands dollars, the U.S. government would have to pay much higher interest rates to finance its $34 trillion debt, crowding out other spending. The dollar would likely weaken significantly, making imports, from electronics to clothing, more expensive, fueling inflation. The ability to maintain a high standard of living while running massive trade deficits would vanish. American foreign policy would lose its most potent non-military tool overnight. So, is the dollar's reign over? Not yet, and not completely. The dollar still comprises about 60% of global foreign exchange reserves, far more than the euro, yen, and yuan combined. The U.S. economy and financial markets remain the deepest and most stable in the world. However, the trend is undeniable. We are moving toward a multipolar currency world where the dollar shares the stage with regional blocs